Probably you don't know about me. My name is Manjula and I am currently teaching at University of Ruhuna. I think this is my third or fourth time conducting a similar lecture for Institute of Bankers in Sri Lanka. Uh, Mostly the same topic over the couple of past years. And it is good that this is one of the easiest topics that we have to learn. Easiest in the sense easier to learn, but all of us may agree that it is very difficult to implement this in practice due to various reasons. We will discuss them while we are going on with the lecture. And this is nothing new also. I think if you have done anything relating to accounting, finance, maybe it is a diploma, maybe it is a degree, whatever, even in A levels, I think there is a sizable amount of content regarding these fundamental analysis or financial analysis, which is sometimes called ratio analysis as well. So I have previously, I think yesterday night, I sent my PowerPoint to Mr. Kalinga. I think you got it from Mr. Kalinga today or yesterday night. With the PowerPoint, I have sent two financial statements, one from LPTA Plantations and the other one, I think, Namanukula Plantations. And we are going to kind of do some little exercise using those financial statements to see how these financial ratios actually can be calculated using an actual Sri Lankan financial statement. And as far as my opinion is concerned, what is more important is not how the ratios are calculated. I think anyone can do the calculations. And remembering a lot of formulas is also doesn't make any sense. Therefore, what's important is to identify some key ratios and be able to interpret and make decisions based on those ratios, right? So I think since you are doing these banking examinations, I assume that almost all of you are either already working in a bank or have an intention to join a bank very soon. Maybe you are working at different levels. If we had a physical class, we could kind of have a chat and share your experience as well. But I don't know whether during an online session, the interaction is a little low. Therefore, time to time, I may ask questions. I am grateful if you answer those questions. Otherwise, maybe you already know doing an online lecture and participating in an online lecture is much more boring than participating or doing a physical lecture, right? So already it is boring, so it may be even more boring when it is done in online. One advantage is that we can join from home and kind of join the meeting casually. I saw that some people enjoy that freedom, but occasionally we forget to turn off the video. Therefore, I kindly remind you that make sure your video is turned off unless you really want to turn it on. And also keep your mic also muted. But whenever you feel you want to talk, when you want to ask a question or give your comments, you are free to unmute and speak, right? And this is the first time that I am delivering a lecture using Google Meet. Therefore, my familiarity with this platform is lower. So if something happens, please excuse me on those. Usually, I do my lectures using Zoom, but this is the first time that I do a lecture using Google Meet, right? So when it comes to our topic, This is commonly known as fundamental analysis, and some people call it financial statement analysis, financial information analysis, and also ratio analysis, right? So all whatever we say, everything refers to the same thing. So during this lecture, I'm trying to explain why we need to use financial ratios when we already have financial statements. And if the ratios are important, why some of the ratios, I mean, everything is not presented as ratios in financial statements. Rather than presenting financial statements, the firms can present the financial ratios, right? So there's something, I mean, we need financial statements, at the same time, we need financial ratios as well. And there are some categories of financial ratios. I know for sure you all know about that. And we will discuss how to evaluate firms using financial ratios by comparing the ratios with our historical calculations and also with peers in the industry. And we will discuss some a little more complex issues like models available for financial analysis rather than individual ratios. There are certain models where we have combined certain set of ratios together to give a better picture. Like you know that even balance scorecard is one of those approaches. Maybe you already learned that in this course unit. I don't have 100% awareness on what you have already covered, but Dr. Dayanand, Professor Dayanand briefly told me what he has already covered. So maybe to some extent, I may repeat certain content that you have already covered during this session as well. So for example, if you look at why we need ratios rather than absolute values, everybody knows that absolute values are almost always misleading. For example, if you want to measure the physical strength of a person, if we just use weight or height, we may not get a proper picture, because there can be a very tall person, but he may be very weak in physical strength due to different reasons. Maybe he is a very slim person suffering from malnutrition, right? But his height is very high. Also, we can take a very heavy person. In that case, also that doesn't reflect the physical strength of that person. Therefore, using absolute values like height, weight, etc., doesn't portray a good picture of what we really want to evaluate. So, can anyone tell me, as a message, or you can say, for example, in this particular case, what is a better indicator of physical fitness or physical strength of a person instead of height and weight?
Middle one.
I'm sorry.
The person is who's in the middle one.
Yeah. I mean, I need the indicator. You are right. Exactly. Left is not good and the right is not good. Middle is good, but that is our visual observation, right?
BM.
That's right. Exactly. There is some indicator called body mass index. So that's calculated based on height and weight, and then it is expressed as a certain ratio. So by just looking at the body mass index, we can have a much better picture of that person's physical fitness rather than looking at height. Because if you look at height, we have to kind of on the side, we have to look at the weight as well, because height itself does not portray the right picture. Same thing happens when we try with weight also. But when we try with body mass index, since it is calculated based on both measures, it gives a better picture, right? So it depends on the requirement that we are using the indicator for. But usually we can see ratios portray a better picture than absolute figures, particularly when making certain decisions. So, as I mentioned earlier, this topic is sometimes known as fundamental analysis also, and you may have a lot to share with me. What is the relevance of fundamentals, particularly in determining a firm's performance or the share prices? Generally, the profitability of a firm, revenues, assets, liabilities, and growth potential are considered as fundamentals. And we know that in theory, the stock prices, for example, if you look at the Colombo Stock Exchange and listed firms in that market, actually the share prices should be closely connected with the fundamentals in theory, right? But in practice, we know that there are a lot of deviations from the fundamentals. Even though the fundamentals are very good, there can be very low share prices, and in some cases, even though the fundamentals are very bad, there can be very high share prices, right? So there is a contradiction between theory and practice. Therefore, whenever we go ahead with the ratio analysis or financial analysis, we have to keep that in mind as well. It is not only the fundamentals that matter in determining a company's success. And anyway, we will discuss those limitations later after covering some of the ratios first. So usually financial statements portray a more or less comprehensive picture on the firm's fundamentals. For example, if you look at just profit and loss account and balance sheet, I mean, even if we ignore other financial statements, these two key financial statements provide a very comprehensive picture of the fundamentals. The problem is someone can manipulate. For example, in a particular year, the management can show a very huge profit, or they can show a very favorable asset position by manipulating certain figures, even when there are regulatory standards like accounting standards or whatever standards. Still, there is room for manipulation. Certain manipulations can be identified using ratio analysis, because when one ratio, when we want to keep one ratio at a very high level, maybe it is reflected in opposite movement in another ratio, right? If we manipulate, but if everything goes well, usually all the ratios move favorable. So through financial ratios, what we are going to do is we are going to kind of squeeze, summarize what is presented in financial statements. For example, we know that average person cannot comprehend the content in a financial statements. For example, even somebody has an accounting diploma or has completed A-level successfully in accounting stream, may not be able to understand and interpret the content of a financial statement, particularly the ones that we practically see. Therefore, through ratio analysis, we are going to combine a lot of information together and present some kind of summarized measures. For example, we can just say return on equity, return on assets. So rather than going through the entire financial statement, one can have not a comprehensive view, but adequate idea about that firm just by looking at 2-3 numbers when ratios are presented. Okay. And for example, you know that there is a claim also that whatever you present in financial statements, nobody cares about those information. People look at just what happens in the share market. If the prices seems to go up, they purchase shares of those companies, and if the prices are going down gradually, they tend to sell the shares of those companies, right? That's also well-recognized fact. That is, people don't look at not only the financial statements, they don't even care about the financial ratios. They just look at what happens to the share prices, kind of speculation, right? They just measure the well-being of a firm just by looking at the movement of share prices. That's also good. I mean, I don't think that that's a problem, because what ultimately matters is, for example, if I am an outside investor and I'm not engaged in the management, I don't care what happens in the firm. What I really want is getting some higher return than what I invested. Right? For that purpose, I don't need ROA, ROE, quick ratio, asset turn. No, I am not interested in those things. For example, if I can buy low and sell high, that's what I want, right? Maybe, I mean, kind of speculative investor. You know that there are two types of investors as well. The type that I just mentioned is known as speculators. They are not concerned about the firm's well-being. They just want to make profits based on market fluctuations. But on the other hand, there are entrepreneurs, speculative investors and entrepreneurial investors. Those entrepreneurial investors want to hold their money for a long time in the firms. Therefore, they are very much concerned about how the firm is functioning. So those type of investors kind of go through the annual reports, evaluate financial statements. They tend to participate in decision making. Therefore, kind of they engage in ratio analysis by maybe they are on their own, or already some of the ratios are disclosed in the financial statements as well, right? Therefore, those two type of investors are there. Among them, those speculators, those speculators are really not concerned. Can you hear me now? Some people say that they can't hear me clearly. Okay, if many people can't hear me clearly, let me know, right? So sometimes maybe the problem is from your side. If many people can't hear me clearly, the problem may be from my side, right? So speculative investors are not really concerned with the fundamentals. They just look at, even if the firm is going to collapse, some people may purchase shares just to make profits using short-term price fluctuations. And for using strategies like short selling, right? So when we evaluate financial ratios, also we have to keep in mind that we can't say that any ratio has any optimal value. There's nothing like that. Sometimes we have learned in the past that current ratio should be something like this, quick ratio should be something like this, debt equity ratio should be something like this. I think that's nonsense. There is nothing like that. There are no benchmarks. There are no optimal values for any ratio. It totally depends on the actual conditions of a firm. And without looking at those real situation of the firm, we cannot interpret any ratio, whether it is favorable or unfavorable, right? So when we actually want to make a meaningful judgment based on a particular ratio, either we have to compare it with a similar firm, or we can compare it with the industry averages. That is usually known as static analysis, where we are comparing, for example, 2020 financial ratios of our firm with the similar other firm, or with our industry averages. And that's known as static analysis. And on the other hand, we can do a dynamic analysis by comparing our this year's ratios with our past year's ratios. For example, we have calculated the same ratio for last 5 years, and then we can check what is happening to our current ratio over the past 5 years, or what's happening to our quick ratio over the past 5 years, right? If there is a fluctuation, why there is a fluctuation? If it is going down gradually, we can investigate why it is going down, right? Same thing when it is going up also, right? We can't be happy when a ratio is going up or going down. For example, even if we, for example, generally we may feel that if we increase the profit margin, for example, profit margin is a ratio, and some people may say that if the profit margin is continuously increasing, it is a good sign, right? But I think we cannot say like that, because we can improve the profit margin in various ways. Therefore, there can be a short term, or we can maintain a good profit margin for several years, but later we may experience much bigger problems, right? Therefore, we should not focus on single ratios. We always have to look at many ratios, and at the same time, we have to compare it with peers, maybe industry, or with our own past ratios if we want to make a meaningful judgment. How about the voice now? Is it clear now?
Yes, sir. It's clear.
Okay. So as we have learned in the past, these are the main categories of financial ratios. Different people categorize them differently, so don't worry if my classification does not tally with some of the classifications that you learned earlier. There's no any well-established standard categorizing this ratio should go to that category or something like that. But there are certain ratios which are clearly under certain categories, but certain ratios can be placed in different categories, and there can be different number of categories, and there can be different names for certain categories. For example, asset management ratios are sometimes called activity ratios, and solvency ratios are sometimes called leverage ratios, right? Like that, there can be different names. There can be different number of categories as well. Definitely there are some other categories, but I did not include or cover those categories in this session, right? So let's take the first category first. That's liquidity ratios. By the term, we can identify that liquidity means our short-term financial availability. If you want to define it more clearly, it is the ability of the firm to meet its short-term financial obligations, right? So usually short-term financial obligations are met with short-term financial assets. So there are a number of ratios, but I have just taken a few ratios which are very commonly used in practice. The first one is current ratio. That is actually the ratio between current assets and current liabilities. And there's another one called a quick ratio. It is actually the ratio between monetary current assets, and total current liabilities. Can anyone tell me what is the most crucial element that we exclude when we calculate the quick ratio? I mean, when we compare quick ratio with the current ratio, what do we exclude when we calculate the quick ratio? Yeah, very good, very good. Yeah, generally, I mean, stock or inventory is the least liquid asset in the current assets generally. Therefore, we tend to exclude inventories when we calculate the quick ratio, and that will reflect better liquidity position, right? Because even if you want to settle certain obligations, we cannot use inventories practically to settle obligations, because first we have to sell them, and then only we can use the proceeds to settle the obligations. Therefore, some people say that if you really want to find a very short-term liquidity position of a firm, you better look at quick ratio rather than current ratio, because current ratio contains inventory also. But most of the liabilities, I mean, most of the current liabilities may be more short-term or liquid than inventories. Therefore, some people are, and also some people exclude prepaid expenses also when we calculate the asset ratio or quick ratio, right? But that's not common. But in some books, they say that not only inventories, but also we have to deduct prepaid expenses. Prepaid expenses is a current asset, right? But we know that actually we cannot recover prepaid expenses. For example, if we have paid additional amount for our electricity bill, for example, if my electricity bill is 100,000, and if I pay 200,000 as the electricity bill, definitely I can recover it next year. But assume that I have a short-term obligation to be settled very soon. Can I call the electricity board and ask that I have paid 100,000 in advance? Can I take it back? We can't, right? I mean, we cannot realize it. Prepaid expense. Most of the prepaid expenses cannot be realized. Therefore, actually, considering prepaid expenses when we calculate the quick ratio or as a measure of liquidity is not so logical, right? Maybe inventory we can sell reasonably well, right? But prepaid expenses actually almost impossible to be realized. I mean, we cannot liquidate prepaid expenses, right? For example, assume that I want to settle a creditor. Still we can't say, okay, I have paid the electricity board 100,000 advance. You can use that to settle your electricity bill. That is also not possible, right? Because that kind of arrangement is not available in the electricity bill. That means my asset is not transferable. I cannot convert it into cash at all. Right? In most of the cases, if we have paid telephone bills, maybe rent, electricity, most of the prepaid expenses cannot be recovered. We have to wait until the next bill, and that will be settled off or set off against the next bill only. And therefore, just keep it in mind if you have not heard about that. It depends, right? It depends anyway, because you know that why we are worried about inventory only in most of the cases. Why we are generally talking about these prepaid expenses when we talk about the quick ratio? What is the reason?
Possibility of liquidize.
Any other idea? I mean, if you look at the relative size, I mean, relative size of inventory and relative size of prepaid expenses, what do you think? I mean, in terms of value, the value of inventory is huge, right? In most of the firms, maybe large part of the current assets is inventory. But prepaid expenses actually account for a very small fraction in the current assets. So whether we exclude it or whether we include it when we calculate the quick ratio doesn't make big difference for most of the firms. And that's why generally it is not discussed when we calculate the quick ratio, because whether prepaid expenses are excluded or included, that doesn't make big difference in the quick ratio. But there can be certain firms where inventory is not large, but prepaid expenses, on the other hand, constitute a substantial portion of their current assets, right? In that case, it is more logical to deduct not only inventory but also prepaid expenses. Right? So as I said earlier, that depends entirely on the nature of business you are in and the purpose for which you are calculating these ratios. Right? For example, if you are really interested in evaluating this very short-term debt payment ability, maybe quick ratio is better, and when we calculate the quick ratio, it is better to remove both inventory and prepaid expenses. But if prepaid expenses are negligible, negligibly small, we can just ignore it, right? It is immaterial. So that's my explanation, right? So if you have any idea, you can present. Present means you can speak or you can type it. Or you can raise hand, right? I don't know what happens when somebody raises hand in Google Meet. Okay, then another liquidity ratio is payables turnover. That's actually how often we pay our creditors. And also there is another ratio called receivables turnover or payables period or receivables period. Those are some indications how well we manage our current liabilities and current assets. For example, whether we are immediately paying our creditors or we take the maximum available time for settling creditors, whether we give longer time for debtors to settle their amounts due, or whether we try to immediately recover them, can be identified using payables turnover and receivables turnover. Right? For example, assume that one firm is having a very high receivables turnover, very high receivables turnover. Right? Do you think it is good? Very high receivables turnover means your debtors are paying very quickly, right? Your debtors are converted to cash very quickly. Is it good?
Yeah, high liquidity.
High liquidity, yes. But is it good always? Can anyone tell it becomes a bad one? I mean, sometimes it is a bad indicator. It may have long-term negative effects. Can anyone tell one such negative effect of having a very fast receivables turnover or a very fast recovery of debtors? Okay, how about our creditors? For example, we have to settle our creditors also, right? Do you want that to be higher or lower? Payables turnover.
Higher.
Should be longer.
Longer means we are paying slower, therefore our payables turnover will be lower, right? As a firm, we want to lower our payables turnover, right? I mean, in order to increase liquidity, we have to pay creditors slower, taking much longer time as possible, right? But we want our receivables turnover to be high. But if you look at from that other firm's perspective, because when that person is a debtor for our firm, we are a creditor for that firm, right? So they expect or they plan to lower their payables turnover. Right? They want to lower their payables turnover. That means they want to take longer period for settling debts due to our firm. Right? But if we follow a very aggressive recovery strategy, right? if we force our debtors to pay earlier by maybe by specifying kind of unfavorable credit terms, maybe charging interest rates for additional time taken, giving only short credit period, we can increase the collection, right? But when we increase the collection from debtors, those debtors become unhappy because they are also managing their current liabilities, right? So they want to lower their payables. Payables turnover. That means they want to take longer, but we are forcing them to pay faster. Therefore, sometimes when we maintain very high receivables turnover, it may indicate that in the near future we may lose some of our good customers, right? Because we are very keen on collecting. So they may find better suppliers elsewhere, right? They may drop us. Therefore,
Sales.
yes, as you said, sorry,
Yeah, sales turnover
it's
will
very,
be going down. No?
that's right, right. We may lose customers, so our sales may go down, as you correctly said, right? So that maybe it is not reflected in this year's financial statements, but we may experience that next year, maybe during the next financial year, right? So actually we have to, that's why we have to be continuously monitoring our ratios, right? So we can't say when the ratio is moving in our favorable direction in the short run, it may always be good in the long run as well, right? So as I agree with you, maintaining high liquidity is good. Recovering faster if possible is good, but at the same time we have to look at it from the other side as well, right? Payables also same. We can delay payments whenever.
Can't hear you, sir.
Really? Is it Udeshan?
So audio is breaking, maybe for me or for all of us.
How about others? I mean, is it breaking?
We can hear you clearly, very clearly.
Yeah,
Okay,
it's okay
maybe
with us.
then in that case it's only you, right? So if you
Okay.
okay, I'm sorry about that. That's usual in online lectures. So kindly, if my audio is breaking, kindly have a short text message on the chat. Then I can see how many of you are experiencing that audio problem, right? So if it is only one person, I may not respond. But if there are many people experiencing problem, I can turn off my video. In that, shall I turn off my video, or do you prefer to keep it going?
Yes, it's okay.
Okay, let me know if you have hearing problems, right? So what I was telling is payables turnover. Sorry? Yeah, payables turnover, we prefer to delay our payments to our creditors, but when we always delay, the creditor may kind of have a negative impression about our firm, right? We are always taking the maximum period allowed, so that may not be viewed from the creditor's perspective favorably. They may kind of think of us as a notorious buyer, right? From their perspective, we are a buyer, so they may not give enough priority for us, right? So we have to be very careful. Even though certain things are favorable for us in the short run, that may create longer term negative effects. Okay, then I will turn off the video. Then I think bandwidth will be reduced, and so audio will be okay for most of you, right? Okay. So that's about liquidity ratios. Kind of, maybe you can always remember how to calculate current ratio, and you know how to calculate quick ratio. And if you look at the payables turnover and receivables turnover, they are both very similar ratios. Therefore, try to remember few ratios if it is relevant for the examination also. But as I said earlier, calculation will not be the primary focus in this lesson, right? Mostly it depends on how well you can interpret or identify the consequences of a higher or lower ratio. Then we will move to next one. That's solvency ratios, right? So that's kind of a long-term, kind of indicate the long-term survival of the firm. It's basically reflected in long-term assets and long-term liabilities, more or less long-term kind of equity. Mainly it is the leverage, financial leverage. That's why they are known as leverage ratios also in some books. There are many ways to measure leverage. For example, one of the commonly used indicators is debt to asset ratio. That means what percentage of debt you have in your firm related to your total assets, and debt as a percentage of equity. That's another way. So they are usually calculated based on balance sheet figures. Both of the first two ratios are only based on balance sheets, but this one in times interest earned is a kind of a profit and loss account indicator. That's why it covers how many times is your return relative to interest expenses. So if you have kind of a larger profit and smaller interest expense, that's a good situation generally, right? For example, if you look at now our economy situation, I mean Sri Lanka, if you look at the government income, I think government income is barely sufficient to pay interest of that particular year, right? So that's not good. I mean, income is almost equal to interest payments. That's kind of a bad situation. So that can happen to firms also. If you are excessively levered in economic downturns, right? Maybe in economically good terms, your firm is performing well, so you have enough profits. Therefore, you will not have any problem in paying interest, because interest will remain constant even if your profits go up. But in economically bad times, your profits will go down, but interest expenses will remain the same, because interest is paid on debt. Debt usually has fixed interest payments. So whatever your profits, you always have to pay interest. Therefore, even in a very good firm, during an economic downturn, this ratio can be moving in unfavorable direction. So that may not be reflected in debt to asset ratio or debt to equity ratio, because whether the economy is good or whether the economy is bad, I mean whether the firm is performing well or whether the firm is performing poorly, the debt to asset ratio and debt to equity ratio will remain the same, because depending on the economic situation, nothing will happen to debt and equity or total assets. But economic condition has a serious impact on the profitability, right? So that can only be captured with profit and loss account based ratio, like times interest earned, and there's another ratio called interest coverage ratio also. Same name, the same thing. So if you have multiple times of return relative to interest expense, that's a good indicator. right? And this can be increased or improved by lowering the interest. If you lower the interest, we can improve the interest coverage or interest times interest earned. But you know that if we are lowering interest, that means we are delivering our firm. That means we are using less and less debt. So that's also not good, right? Because without debt we can't expand. But to some extent we need to have debt. So if we just look at the interest coverage, and if your board of directors say, okay, you should you should improve your interest coverage, or you should improve your times interest earned ratio, then the management can aggressively reduce debt just to show that they are performing well, because they know that their directors are just looking at the times interest earns. So that may give a very attractive picture in the short run, but in the long run, since you don't have enough leverage, you may not be able to boost your profit. Right? That's a similar kind of interpretation. Just because interest coverage is higher or times interest earned is higher, we can't say that the firm is performing well. It may be an indication of another issue, right? So always we have to look at why it was changed, right? Why the times interest earned went up or went down. Only after looking at the reason, we can have an idea about whether it's a favorable movement or unfavorable movement. And do you have any questions? Okay. And the next ratio is equity multiplier. That is the ratio between total assets and equity. So here also it's kind of a leverage indicator. If you have more total assets and less equity, that means you are levered and you are using debt to finance your assets. So higher the ratio means higher the equity multiplier, higher will be your leverage. So when the leverage is higher, the risk will be higher, right? I have kind of given it a green highlight because this will be one of the ratios used in DuPont analysis, right? So there are several ratios that I have highlighted in green in the next couple of slides as well. So those are actually used in DuPont analysis. We will discuss that later, and I know for sure you already have learned about DuPont analysis. Okay, leverage is not a bad thing, right? I mean, leverage does not always indicate insolvency. For example, in your particular industry, in banking and finance industry, what is your impression about your leverage compared to non-financial firms? Is it relatively lower leveraged or highly leveraged? Highly leveraged, right? Highly levered. Well, it's not bad, right? I mean, for a bank or financial institution, it has to be the case. If a bank tries to finance entirely with equity, that bank will not be able to survive in the market because their ROEs will be very lower if it is totally financed with equity. It is not possible, right? Because most of the liabilities in banks are deposits. So if you want to run without deposits, I don't know whether it is a bank, right? Therefore, leverage is good, but we have to look at in which industry we are in and what is the economic forecast for the foreseeable future. For example, As shown on this slide also, if our return on investment is higher than the interest rate or cost of debt, leverage is good. So usually return on investment is higher when the economy is good. When the economy is good, the demand is high, uncertainty is low, economy is functioning well, therefore sales and profits of the firm will be higher. Therefore ROI will go up, but KD will remain same, right? But if the economy is bad, demand will be lower. We can't, for example, these days, most of the firms are struggling to survive. So their ROIs go down. But KD remains same, right? So if somebody does not lower the KD, most of the businesses will collapse. That is one of the reasons why the government continuously lowered their interest rates and provided this debt moratorium, etc., in order to keep the firms running. If they cannot settle their loan obligations, they may have to bankrupt, and then bank will face much bigger losses. Therefore, as far as KD is lower than return on investment, leverage is good. Therefore, we can't say this much leverage is the optimal leverage. If it is higher than this, it is not good. We can't say something like that, right? So it totally depends on nature of the firm and nature of the economy we live with, and the amount of risk that we are going to bear. For example, if I am a very risk-averse person, if I am allergic to risk, I better run with equity only. But if I am a person loving risk and I am not afraid of risk, in that case, I can go with little more leverage. Okay, then next third category is asset management ratios. This indicates how well a firm is utilizing its assets. It may be fixed assets or total assets. Right? So, okay, here we have a ratio called fixed asset turnover. That actually indicates how well you utilize your fixed assets. And if you look at the total assets turnover, it indicates overall how well you use your total assets, overall assets. And again, this green ratio is used in DuPont analysis. That's why I have highlighted it. Otherwise, some people may think that I have highlighted the ratios that you have to remember, right? I have not done that. I can't say which one you should remember and which one you can forget. But generally, it's better if you remember 2-3 ratios in each category. I don't know which ratio, but at least 2-3 ratios, right? Inventory turnover, which is very closely connected with, as we mentioned, with receivables turnover, etc. Right? For example, if you want to if you want to sell rapidly, you have to have very liberal credit policy, right? I mean, you have to give discounts, you have to give extended periods of credit, very favorable credit terms. Then you can boost your sales. Then your inventory turnover will be higher. But at the same time, since your credit terms are very favorable to the debtor, your receivables turnover will be lower. Right? So, I mean, if you want to improve your inventory turnover using that approach, that indirectly negatively affects the receivables turnover. Right? That's why I mentioned that if you want to manipulate, for example, assume that my performance is mainly monitored using inventory turnover, right? So assume that I am relating to marketing, then I may try to boost my inventory turnover, right? Then I can show my performance. But on the other side, the recovery division will say, okay, we are having big trouble in recovering from debtors because we have given unreasonably favorable credit terms in order to boost sales and lower inventories, right? So in that case, even though our inventory turnover is very high, we cannot be happy because our receivables turnover is getting lower. So actually they are about current assets, right? And in certain firms, these ratios may be very good, right? But there may be very huge amount of unutilized fixed assets. Closed down factories, closed down buildings, unused vehicles, right? In that case, even you are selling, recovering, paying, everything is good. Your fixed asset turnover and total asset turnover will be lower because there are a lot of assets which are not utilized efficiently. In that case, that's reflected in the asset turnover. Or maybe assume that in order to, for example, we don't give a favorable credit policy, but still we want to improve inventory turnover, and also we want to improve receivables turnover. Assume that we start a very extensive distribution network. We buy a lot of vehicles, and instead of selling in our showrooms, we send delivery vehicles everywhere. I mean, kind of we deliver to all the places, right? In that case, we need a lot of vehicles, we need a lot of manpower, etc. We need a lot of assets. But if the sales does not go up at the same rate, asset turnover will go down. But our inventory turnover will be higher, receivables turnover will be higher. For example, we can, without waiting for debtors to come to our place and settle their debts, we can go to debtors' place and time to time ask to settle their debt, like those polymodulalis are doing. Then we can improve receivables and inventory turnover, etc. But our fixed assets will increase and other assets will increase. In that case, assets turnover will go down. Right? I think this is the last set of ratios. Yes. If you have any question about any ratio, you can ask, right? I mean, if you need any clarification. Anyway, I'm quickly going through the ratios first, and then we will have an example and we will calculate certain ratios ourselves, and during the calculation we will look at more about each individual ratio. Then profitability is usually related with the profit and loss account. Here we have gross profit margin, net profit margin, operating profit margin. Those three are very closely connected three ratios. Gross profit margin, as it is implied by the name, is related to the gross profit. All these ratios are relative to sales, right? So it's easy for you to remember. If it is gross profit margin, gross profit divided by sales. If it is net profit margin, it is net profit divided by sales. And if it is operating profit margin, it is operating profit divided by sales, right? So, so usually higher the better, né? Usually higher the better. But as I mentioned earlier, higher gross profit, higher net profit also can indicate certain problems in the firm. If it is unnecessarily higher than the other firms in the other similar firms, maybe we have to think of lowering it, right? Lowering it, because when we lower profit margin, we can kind of improve some other ratios. Let's look at them. Okay, another big issue that we when we calculate ratios is now when we look at the formula, it's very simple, right? Net income divided by sales. But if you look at an actual balance sheet and actual profit and loss account, there are a lot of complications. What is net income? What is operating profit? Right? What is sales even, right? Because sales is not a single figure in most of the profit and loss accounts. Whether we count something with sales, whether we don't count something with sales, whether we include tax, whether we exclude tax, whether we include interest, whether we exclude interest, are some of the concerns, not only for these ratios, but also for other ratios also, right? For example, what are total assets? What do we count for total assets? What do we count for average receivables? What do we count for average inventory, right? Or inventory? Because there are multiple items in each category. So in certain cases, we consider certain items and we do not consider certain items. And also, I forgot actually to tell it. Sometimes the average values are used, right? For example, that's applicable to all ratios, right? Almost all ratios. For example, look at total debt. We can use total debt at the end of the period divided by total assets at the end of the period. That is one approach, right? No problem with that. But most of the time, people use average total debt and average total assets when they calculate debt to asset ratio, right? For others also same. I think, for example, if you take debt to equity ratio, it's more appropriate to take average total debt divided by average net worth. Right? Average in this case is simply the, for example, if it is total debt at the beginning of the period plus debt at the end of the period divided by 2. Opening debt plus closing debt divided by 2. So that is the most appropriate figure for that, right? So assets also there. Opening assets plus closing assets divided by 2. Because there are also some people can manipulate, right? For example, assume that we want to improve our debt to asset ratio. For example, assume that we have 50 in debt and 100 in assets. For example, on December 20th, we pay all the debt. Right? From January to December, we have 50 debt. But in December 20th, just before we close the financial year, we pay all the debt. Then our debt to asset ratio will be very low, right? I mean, our leverage will be very low. But actually, that's applicable only for 10-15 days. But throughout the period, our firm has been levered heavily, substantially, right? So in that case, that type of issues can be resolved when we take average total assets, average total debt, average equity. Here, no problem, right? Because it's an annual figure. In all these stock figures, stock means on a particular date, right? For example, debt as at something, equity as at some date, total assets as at a particular date, right? So they are kind of stocks. So when we take profit, interest, expense, etc., they are for a period. So we don't need to take average for those values, but when we take these balance sheet items, it is more appropriate if you take average values. Average values, again, there are many ways of calculating averages. The easiest method is opening balance plus closing balance divided by 2. But still, some people claim that people can manipulate here also. For example, they can have lower debt at the beginning, lower debt at the end of the period also, but in the middle they can have higher amount of debt. So what some people suggest is you take month-end values. Okay, that's a good question. I will come to that question later, right? Yeah, I mean, take monthly values, right? I mean, January end balance, February end balance, March end balance. Take all the values and add them together and divide them by 12. In that case, it's very little opportunity for someone to manipulate the ratios and take a more comprehensive average than getting end value and beginning value and taking the average. So those concerns are there, right? I mean, as far as we are using the same approach for all ratio calculations, there will not be a big issue. But actually, certain small changes can be made to improve the validity of our ratios. For example, taking average is one of such approach. Therefore, I have indicated average in certain ratios, but I have not indicated average in certain other ratios. That does not mean that, for example, this particular ratio has to be calculated using average inventory. No, I mean, if you want, you can put here in inventory, right? Total inventory at the end of the period as well. It's more appropriate to take average. Even in these cases, it is not really, I'm not dictating anyone to take year-end assets and year-end debt. It's always better to take averages. Average, right? Okay. Then there's one question saying that certain ratios are not included in the version that I sent to you, right? But you can write it down, right? Actually, it doesn't matter, right? It doesn't matter what ratio you have with you in your handout and what ratio is not included there. Anyway, there are slight differences in the version that I sent to Mr. Kalinga yesterday night, and I updated certain slides today morning. Therefore, if you find any discrepancy, kindly have some notes on those. But even if you don't have notes, it will not seriously affect your examination, right? The only thing is, it's always good to go with the latest version. Actually, this handout is just to facilitate my lecture, and it is not a reading material for you. I hope that you have some recommended textbooks. You are going through those recommended textbooks, and you may be listening to this lecture recording later. Therefore, keep them as your main learning materials, and these PowerPoint slides are just to facilitate me in doing lecture. Right? For example, when I see things in the slide, I can memorize what I should talk during the lecture. Right? Other than that, I don't think it will be an effective learning resource for you. Therefore, as you said, yes, operating profit margin, I think I added later, and in certain slides, I have slightly rearranged certain formulas as well. And the other question is net credit sales. So just forget it, right? Where did you find it? Which ratio? Oh, okay. Actually, what I wanted to say here is, it's good that you pointed out it. It's not net sales. I mean, normally it's net sales, right? But I know that some people, I mean, some firms only sell on credit basis, right? So in that case, there is no difference between sales and credit sales because all of their sales will be on credit basis. I mean, most of the large firms do that. For example, if you are in the wholesale industry, I think it's only for credit. It's very rare that they sell on cash. Therefore, this ratio is actually net sales divided by accounts receivable, right? But what I wanted to highlight is if you have credit sales and cash sales, in that case, what you have to actually take is credit sales, I mean, not the total sales, right? That is what I wanted to mean here. Other than that, I don't know what is net credit sales, right? Net sales means you know that when we are selling certain things, we have to sometimes there are sales returns, etc. So in that case, net sales will be equal to sales minus sales returns. Right? Otherwise, there can be very large amount of sales, but in the following month, everything has been returned. Right? That's why usually it is mentioned as net sales, but actually, practically speaking, there is no any sense of using the term net there, right? But what's more important is whether we take total sales here or take total credit sales, right? So if the figure for total credit sales is available, usually receivables turnover should be calculated using credit sales divided by accounts receivable, right? That is what I wanted to mean. Thank you. I forgot actually to mention it there. Is that okay? Then yeah, just make a note here, right? The only difference is this. I mean, whenever it says margin, it is divided by sales. If it is gross profit, it is gross profit. Net profit, operating profit, right? So it's not difficult. You know, gross profit is sales minus cost of sales, right? Sales minus cost of sales, that is actually reflecting your pricing strategy, right? For example, assume that I am selling bread. I take one bread at 50 and I sell it 60 at 60. Right? That means I keep 10 rupee margin, gross profit margin. Cost of sales is 50. Gross profit is 10 in this case, 60 minus 50. Therefore, 20%, right? That means I am keeping 10 rupees, right? If you want to boost your gross profit margin, that is usually done through your pricing strategy. For example, if you increase your profit margin, for example, I want to keep 50 rupees margin, then my purchase price of bread is 50, I add 50 rupees, then my selling price will be 100 rupees. Then I have a margin of 50, right? But there is a negative consequence, right? For example, now my bread is very costly. Maybe other firms are selling at 60, 70 or with a lower margin, right? Therefore, a lot of my customers will go to those firms. You know that there are two main strategies for a firm. We can keep a very low margin and we can have large amount of sales. That's usually known as market penetration strategy, right? We don't want much profit from one unit, but our intention is to sell many units, right? Our gross profit will be lower, but we need a lot of sales. I mean, as a margin, it will be lower, but totally in absolute values, it may be larger because we are selling a lot of items. That's one strategy. That's known as market penetration strategy, right? And there can be
Is there any standard amount for gross profit margin and net profit margin?
No, in my opinion, no, right? But you know that in certain textbooks, I mean, not really for profit ratios, but for leverage, current ratio, asset ratio, etc. Some people say certain benchmarks. Well, for example, current ratio, maybe in A levels also, you remember that they say it should be 2 to 1. Quick ratio should be 1 to 1, right? So this type of kind of discussion is there, but what I mean is, in my meaning, I mean, you are advanced learners, you are actually working in firms. So for people like you, I think talking these things is nonsense, right? So even if I have current ratio of 1 to 1, which actually should be 2 to 1 according to certain textbooks, if there is no problem with our business model, and if we are very comfortable with this 1 to 1 current ratio, we don't need to worry. Maybe it is the industry standard, right? Maybe it is the nature of that industry. But in certain industries, maybe 2 to 1 also risky. Maybe they need 5 to 1. Right? It depends on the circumstances. Therefore, I personally do not agree with those optimal values or benchmarks, right? There is nothing like that. But generally, in particular industries, they have set certain, I don't know that, right? Because I'm not in a particular industry. For example, let's take a bank, right? For example, in a bank, there is a kind of recognized return on equity. Right? If a bank is not earning that return on equity, usually it is considered an ineffective bank. Right? For a bank, you should have that much of return on equity, because return on equity is the return, right? So depending on the amount of risk associated with that industry, the return on equity should be higher. For example, assume that I am doing a retail shop and you are doing a bank. And if I am having a return on equity better than the bank, then there is a problem, right? There's a problem means the retail business is very less risky compared to running a bank. Therefore, if retailing has more return on equity, a lot of people who have invested in banks, I mean, equity holders of banks may think that why the hell we take additional risk by investing in banks? We should sell the shares of banks and buy shares of retail companies. Okay, so when a lot of people move to retail industry, the move to retail industry means the demand for shares of retail companies will be higher, right? So the price of those shares will go up. At the same time, the price of shares in the banking industry will go down, right? So then certain ratios will change in opposite directions. Right? Therefore, frankly speaking, my opinion is that there is no such benchmark or optimal value for any ratio, right? Always it depends on the qualitative characteristics of that particular industry and the strategy that firm is following. For example, that's why I mentioned here, if you are following, assume that there are two firms doing the same business, two banks, for example, right? Actually, banking is not a good example, but I assume that there are two banks doing the same type of business, but one is following a market penetration strategy. The other one is following a market skimming strategy. Market skimming means they don't want a lot of customers, but they skim the fewer customers with higher profit margins, right? Yeah. වෙළඳපොළ සූරා කෑමේ ප්‍රතිපත්තිය කියලා කියන්නේ, right? Fewer customers, higher profit margins. They can also make higher profits. But on the other hand, other firm is going with the market penetration strategy where they keep lower profit margins with large amount of sales or customers, right? So if we don't look at that difference in the strategy that they follow, we may be misinterpreting the inventory turnovers, profit margins, everything, right? Therefore, we have to look at what's happening behind rather than comparing whether a certain ratio is up to certain level or not. Okay. But always, as you said, there are industry-specific optimal values, right? I mean, I don't know, for banking industry, there are certain set of values for set of ratios. Okay, these are the optimal ratios. For plantations, there are set of optimal values. That doesn't mean that the bank has to maintain the same return on equity that a plantation has to maintain, right? They are different. Then so as I said earlier, gross profit margin is largely connected with the markup that you keep when you are selling your items. If you keep higher markup, your gross profit margin will be higher. Net profit, when it comes to net income, right? Usually this is profit after everything, profit after tax. Profit after tax, right? Profit after interest and tax. Final profit divided by sales, right? When it comes to operating profit, it is usually known as earnings before interest and tax, right? This is actually operating, no other word, right? Operating profit margin, because you know that the profit is influenced by two factors which are not really within the control of operational staff of a firm. For example, this interest and tax, right? Because operating staff has nothing to do with this interest, right? So this is connected with the leverage. In higher the leverage, you have higher interest, right? There can be two firms doing the same business. One firm does not have any debt, the other firm has debt. So if we deduct interest, only one, I mean, assume that the both firms are making equal profits. I mean, they are performing exactly same. But if we deduct interest, that firm's profit will be lower because they are deducting interest. But that is not within the control of the operational activities of the firm, right? I mean, by doing anything within the operating activities, they can't change the interest because that is connected with the leverage, and leverage is usually connected with top management decision to use debt or not. Therefore, considering interest is not appropriate, and also tax is beyond the control of the firm. Taxes change, and some firms are tax exempted and some firms are tax liable. In that case, considering tax is also not good, right? Actually, this operating profit margin is used mainly to evaluate the performance of the management, right? How well the management perform, because interest and tax actually are beyond the control of those operating managers. Therefore, if you want to measure the performance of management, maybe operating profit margin is good. But if I am an outsider, I want to measure the performance of the entire firm. I don't care whether the operating managers are working well, finance managers are working well. I don't care who works well. For me, I need the firm to perform well. In that case, for me, net profit margin is the appropriate indicator. But if the management is, for example, in order to give a bonus, in order to give a promotion, if another firm want to hire that manager, so in that case, they don't want to look at the profit margin, right? Because that's mainly affected by these two, interest and tax. That's why I can't say you have to use gross profit margin, net profit margin, operating profit margin, but depending on the circumstances for which you are using the ratio, you have to choose which ratio better fit your analysis. So this is usually profit after tax, the final profit. And this is usually earnings before interest and tax. Those are the terms actually used in Sri Lankan financial statements, right? And then there is another set of ratios, ROA, ROE, ROI, etc. Right? I think they are a little similar. So here also we take the net income, that means profit after tax, as a percentage of total assets, right? What is the percentage of return that we are going to get from that? And sometimes this is very similar to return on investment also, I think, right? Because investment is equal to assets. And then this is return on equity. Sometimes it's known as return on capital employed. But capital employed is commonly known as equity, therefore it is ROE as well, right? So then we divide again, another concern here, right? If we have preference shares, we have to deduct the preference dividend as well, because what is attributable to equity shareholders is profit after preference dividend as well. And therefore, we divide the net income after paying preference dividend by equity. Again, taking average or not is your concern, right? If you want, you can take average. For example, if the beginning of the year values and end of the year values are given, for better calculation, you take the average. But if the year end figures are given, only the year end figures are given, in that case, we can just take the year end equity. Usually, in non-financial businesses, there are no large differences between return on assets and return on equity. They are always different, right? But that difference is very small in non-financial businesses. Actually, this difference depends on the amount of leverage. Higher the leverage that you have, higher will be the difference between return on equity and return on assets. So when the leverage is high, usually return on assets are lower, return on equity is higher. Right? That's the main purpose of leverage, right? What is the main purpose of leverage? What is the main purpose of leverage? Can we increase the profitability of the firm through leverage? What is the primary intention of leverage? Anyone? Actually, the purpose of leverage is to boost ROE. We want to enhance ROE. While ROA is there, ROA is lower, but through leverage, we can boost ROE. That is what banks are doing, right? Because banks are highly levered. There is a huge difference between ROA and ROE. So the difference between ROA and ROE depends largely on the amount of leverage. For example, if you are not levered, if you don't have any debt, your ROA will be equal to ROE. But if you are 100% debt finance, there will be a huge difference between ROA and ROE due to financial leverage. Okay. Then that's return on equity and return on assets and return on equity are two similar ratios, right? And then this is earning per share, dividend per share are actually performance indicators from shareholders' perspective, even ROE, right? Including ROE. And actually ROE and earning per share are kind of almost same information. So you can see here, actually this is the same equation, right? Here net income minus preference dividend divided by value of common equity. Here we take the value, right? In rupee terms. What we do here is, the only difference between this and this is we take number of shares here. Right? Here the value of shares, here number of shares. So if you divide this income by the value of shares, you get a percentage that's known as ROE. If you divide the same income or same return by number of shares, then you get the earnings per share. Right? So actually it's communicating the same information. When ROE increases by 10%, earning per share also increases always by 10%, right? So they are kind of perfectly correlated. And there is another earning per share which is sometimes used, and in some firms it's meaningful. Diluted earning per share, where you take total number of possible shares, right? That happens actually when there are convertible other forms of long-term liabilities, right? There are sometimes preference shares convertible into ordinary shares. There can be debenture or bonds convertible into equity, right? So if you have certain things like that, there will be a difference between earning per share basic and earning per share diluted. Why I mainly indicated this ratio is you can commonly observe this ratio in annual reports with summary financial statement ratios, right? So diluted means actually this is the earning per share at the moment, but if those convertible securities are converted into equity shares, this is the lowest possible value for earning per share in that year, right? It's kind of a conservative indicator. It's very safe. If you want to be very safe, you should be looking at earning per share, diluted earning per share. Usually this is lower than the basic earning per share, right? Because the denominator is bigger here. Total number of possible shares are usually higher than total number of shares outstanding at a particular moment. If you have those type of things, right? Convertible securities. And then again, this is another important indicator, dividend per share, right? That largely depends on the dividend payout ratio. As I mentioned, and maybe I didn't mention, there are two types of investors again, right? Not speculators and entrepreneurs. Okay, let's take entrepreneurs and speculators also good. For example, if you look at entrepreneurs, their intention is not to sell the shares, right? They don't want to sell their shares in the short run. They want to keep it for a long time. So whenever they want to keep their shares in a firm for a longer period, they need interim cash flows, which is usually received as dividends. So if you are an entrepreneurial investor who is looking for that kind of regular payment of profits rather than the capital gain, that you are getting when you sell the shares, this dividend per share matters a lot for those type of investors, right? For example, it doesn't matter how much the firm earns if they are not paying any dividends, right? For example, assume that I am a speculator and my intention is to not to get dividends, but to buy the shares when the price is lower and to sell the shares when the price is higher and get that capital gain. I don't care whether dividend is paid or not. My concern is whether the price goes up or price goes down. As far as dividend is not paid, usually share price goes up. Right? Because whenever dividend is paid, some cash goes out of the firm. Therefore, value of the firm goes down. That usually results in lower share price. Right? Usually, when dividend is declared, the share price goes up towards that announcement, but later gradually the share price falls down. Therefore, if I am type of investor expecting income in terms of dividend rather than earning per share, those investors are looking at dividend per share, how much they pay as dividend, because I need a regular cash flow. In that case, we can divide the dividend paid by that firm during that particular year by number of, actually these are ordinary shares, right? Number of ordinary shares outstanding. Common shares or ordinary shares. Any questions, or do you want to add something? No questions, right? Okay, then we will discuss this slide. And what is your usual practice? I could not ask it from Mr. Carling. When you usually get your break during the class? I mean, do you take breaks or you don't take breaks? Because this is from 1:30 to 5:30. Should we take a break?
Yes, sir.
When?
3:20 to 3:30.
All right. Okay. Then I will stop 3:20, right? Okay. We can cover this also. Actually, these are also profitability ratios, right? Profitability ratios. But you can see almost all ratios that we discussed so far are only, I mean, the figures are only coming from balance sheet or profit and loss account, I mean, book values. But these ratios have certain figures coming from the market. I mean, we have mixed up book values with market values here, right? So some people say these are much better than the ratios that we discussed earlier, right? Because the ratio that we discussed earlier, we will discuss in the next slide when we discuss limitations as well. They are book values, right? Totally depends on book values and accounting procedures that you follow. But if you can combine them with certain market figures, the market you can't control, and you can't manipulate the market easily, like you manipulate your financial state. Right? Therefore, people say it's more reliable to use market-based ratios. For example, here, one is this price earning ratio. That's market price per share divided by earning per share. Price earning ratio, right? For example, if it is very high, it's a good indication about the future prospect of that firm. That means it's highly valued by the market. Right? Market looks at that firm very favorable. That's why the earning per share of that So market price per share is very high in that firm. There's a lot of people are buying the share of that company. So the market price is higher. Right? So higher ratio usually is good. We can manipulate earning per share, right? By changing our number of shares, by changing how we calculate profits, etc. We can, but market price we can't influence, right? It depends on the movements in the market. Therefore, it's a kind of market ratio. And actually, the green one is actually the opposite of the same, right? I mean, if you turn this upside down, you get earnings yield. For example, here market price divided by earning per share. Here earning per share divided by market price, right? So it's the same ratio. I mean, this is the reciprocal of this, and this is the reciprocal of this. Actually, I like this one, right? That's why I highlighted it, not because it comes to DuPont analysis. Actually, this is the rate of return that you are getting from that firm, right? So you can compare this with, for example, prevailing interest rates. For example, if I am getting 10% from this firm, assume that a particular bank has 12% fixed deposit, I may feel that it is ridiculous that I keep my money in that firm because it pays only 10% earnings yield, right? But if I sell my shares and deposit it in this bank, it's much better because in the fixed deposit, I don't have much risk. I don't have to do anything, but I can get a return higher than this 10%, right? So it's kind of a easily interpretable ratio, not like price earning. I mean, this is good also, but it is difficult for many people to interpret. What does that mean? Right? But not like that. I mean, earnings yield is very meaningful and it can be compared with interest rates. Interest rates means like lending rate, deposit rate, LIBOR, etc. With those rates, we can easily compare it. And another thing, if you note it, have you, do you know perpetuity? What is a perpetuity? Maybe you did the time value of money and discussed annuities, perpetuities, etc. Can you remember the present value of an annuity, present value of perpetuity formula?
Cash flow divided by the interest rate.
That's right, exactly. So cash flow divided by the interest rate is equal to the present value. Can you see any similarity between this ratio and this formula? For example, we can move this market price per share here and we will move this earning yield here, right? Then market price per share will be equal to EPS divided by earnings yield. Well, so market price per share means the present value of that firm, right? Present value per share. Usually, you know that the value of a firm is not really the asset value of that firm. Maybe our total assets will have a different value, but the present value of that firm is evaluated differently. So that's the present value of future cash flows. That's the finance approach for valuating firms, right? Accounting approach is to use the total assets in the balance sheet. So actually, this takes that finance approach, right? So the earning per share is our cash flow, right? This earnings yield, as I said earlier, we can compare it with interest rate. That means it's almost same or similar thing like interest rate, right? So we can divide this cash flow, earning per share, by that interest rate, earnings yield. Then you get the present value of present value per share right? That means if you multiply that by a number of shares, then you get the present value of the firm, right? So the present value of the firm is determined in the market based on the expectation of the investors, right? That's why we change these terms here and there, and then we come up with this formula based on that market valuation. If the market valuation is this, what is the effective rate of return? Right? It's like return on assets, right? But return on assets is based on book values, accounting treatment, right? Accounting approach, return on assets. But earnings yield is the same thing, but from a finance perspective, right? Market-based approach, right? Because one part is determined by the market. Okay, then since it is 3:20, I will go for the break, and after the break, we will discuss this Robbins Q, and then we will move to our example. Is that okay?
Okay, sir.
Okay, then see you at 3:30. Then we were talking about this Robbins Q. I mean, we were to talk about Robbins Q. Maybe it is not familiar to some of you, and it is not very popular in the industry, right? Practically, it is not. I don't know to what extent it is used by the people in the industry, but when it comes to measuring firm value and firm performance from a longer perspective in research, this ratio is most commonly used, Robbins Q, right? It's actually calculated by dividing the total market value of the firm by the total asset value of the firm. Simply said, market value divided by book value of the firm, right? Therefore, usually market value should be higher than the book value. If market value is lower than the book value, that means there is a serious issue. It can be a very short-term issue, probably due to bad information. Occasionally, market value can go down the asset value of the firm. But if we are observing such situation continuously for a longer period, that means there is something wrong in the firm, right, in terms of performance. If there is a very high market value compared to the book value, that also may indicate an issue that may be the result of too much optimism in the market, right? People are aggressively buying shares of certain companies and certain industries because of certain misinformation or due to this herding effect. Herding effect, maybe you have heard it, right? What is herding effect? That's very common issue in stock markets, herding. What is meant by herding? Herding means when large number of people try to buy stocks of a firm or industry, right? For example, when few people are buying the shares of a particular firm, other people may assume that that firm is good one. Therefore, they also try to buy the shares of that firm. Then when some people try to buy the shares of that firm, usually the price of shares goes up, and that gives misinformation to other investors also. They think that that firm may be performing very well. That is why the share price is increasing. Then more and more people try to buy the shares of that firm. Then within a very short period of time, the share price of that firm can go up very high, very high. But later they will realize that that price increase is just due to this herding effect. There is no any favorable change in the fundamentals of that firm. Therefore, few people start selling the shares. Then when few people start selling, then other people also look at, okay, see, those people are selling the shares of that firm. That means the shares will probably decline in price in the near future. Then we also should sell. Then a lot of people start selling. When a lot of people sell, the price goes down. That confirms their initial assumption that the shares price will fall. Then more and more people start selling. Like that, the herding happens a lot in the share markets. The herding means that the investors do not really evaluate the profitability or performance of firms. They just look at what other people are doing. If other people are buying, okay, I also buy. If other people are selling, okay, we also sell. Something like that. That's herding, right? Herd කියලා කියන්නේ මේ රැළ යනවා කියලා කියන්නේ රැල්ලට යනවා කියලා කියන්නේ රැල්ල. So when a lot of people are buying, recently that happened, right? In share market in recent, maybe towards the end of last month, there's a huge increase in the share prices or the market indices. That's mainly due to herding. Herding means people, somewhere there is a triggering point where people are misinformed that you should buy shares in the market. Then a lot of people buy, then the prices go up. Then they even further think that, okay, prices are moving up, therefore we should buy more. Then actually their behavior causes an increase in the share price, not the fundamentals of firms, right? So if this herding happens, the market value of the firm can substantially deviate from the asset value of the firm. So in that case, the firm can be overvalued. Overvalued if the market value is very high compared to asset value, then it is overvalued. That means there is a decline in the near future of the prices. At the same time, if the market value is very low relative to asset value of the firm, that means that firm is undervalued. That means in the near future, there will be a price increase of that firm, right? So something like that we can get by looking at the Tobin scale. For example, if the Tobin scale is very high, it can be due to two reasons. One is the firm is performing very well actually, right? The other one is this herding due to misinformation, lack of information. There can be a temporary overvaluation of the firm. If that is the case, we can expect a substantial decline in the price in the near future. And at the same time, this is providing some guide for investing also, right? For example, assume that if we can find a firm which has maintained a certain Tobin scale over last 4 or 5 years, but suddenly the Tobin scale is very low now. And when we look at the balance sheet, profit and loss account, and the way that firm is performing, there's no problem with the firm also. But Tobin scale is very low. If that is the case, that usually indicate that there is some market anomaly. Due to that market anomaly, this firm is undervalued. But later, the market anomalies will be reversed or corrected. Market will be corrected very soon. When the market gets corrected, the share price of that firm should go up. Right? Therefore, if you find that kind of firm, you can invest in that firm. That means most probably you are going to make a big profit out of that. But on the other hand, if you buy shares of a firm which has a very high Tobin scale, that means that firm's share price is already in the peak. Now we are here. what is next is a decline, right? Because too high, Tobin's Q is too high for that industry or that firm, right? In that case, if we buy shares of that firms, that type of firms, most probably we are going to incur a loss, because in the near future market anomaly will be corrected and then the prices will go down. In that case, we will incur losses. Therefore, this is also one of the performance indicators of a firm or profitability indicators of a firm, but not like these ratios. These are kind of short-term profitability, but these are kind of relatively providing a long-term perspective. Again, some people say can't hear. How about others? Okay. The person who said can't hear completely got lost. That means it's problem with that person. So Tobinski is like that, right? But as far as I know, it's not widely used in the industry. For example, if you look at many people who is investing in Colombo Stock Exchange, maybe they have not even heard about Tobinski, and it is not reported in financial statements also. Not frequently used, right? But in research, it's very frequently used. If you have any question, you can ask me, but I will directly go to this example first. Let's do some calculation and then come back to our discussion, right? So I have given you, as I said earlier, two financial statements. Actually, they are extracts from their respective annual reports. I just extracted the financial statements only, so even the notes are not there. Can you open them now? Not both. I want to open the LPT Plantation financial statements. Can you please do that? And I want you to calculate these ratios for LPT Plantation. Current ratio, asset ratio, inventory turnover, receivables turnover, debt to equity, etc. Actually, I have given 3 columns here. That is just to write down your answers. In the first column, I want the upper part of the equation, for example, say x. And in the second column, I need y. And in the third column, I need the ratio. Right? So this is divided by x is divided by y to calculate the ratio. Right? So can you open the annual report and give me the answer for this current ratio? Just look at the annual report and see whether you can find the relevant information required to calculate this current ratio. It's a balance sheet ratio, right? Can someone say what should be the X? You can type it as a chat message if you don't like to speak out. Just type in millions, right? Because numbers are too long. So you can just type how many millions. Or you can directly calculate the ratio and let me know the ratio. We will calculate for the company, right? There are 4 columns in the financial statements, 2 columns for the group, and the last 2 columns are for the company. And for the company, we will calculate for 2020. Okay, yes, X should be 877. Others also check, right? I got that answer from his answer. $877 million, right? I will take it as a short figure. Otherwise, the correct amount is 877,308,305. What should be Y? Yeah, Y should be 785, ne? 785. 785 is the total current liabilities. You can see it in page number 135. Total current liabilities 785. Total current assets are on page 134. 877 million something, right? Then the answer will be 1.12, 1.11 or 1.1. And please remember that usually current ratio is not expressed as a percentage, right? It's like it's expressed as a ratio, right? 1.1 to 1. Or just we can say 1.1 or 1.1 to 1. Right? That means we have slightly higher current assets related to current liabilities. It's almost equal. Eh? For example, as we discussed earlier, according to those textbook definitions, textbook benchmarks, this is not sufficient because they say current ratio should be 2 to 1, but here it's almost 1 to 1. Eh? That's not sufficient, but I don't say like that, right? That's not my opinion. 2 to 1 is just an average figure. I don't know whether that fits plantation industry, right? So if you want to say whether 1 to 1 is enough or not, we have to look at the optimal ratios for plantation industry. Particularly in Sri Lanka, right? How other plantations operate. If everybody operate like with 1 to 1, maybe that's okay. So maybe, right? So no problem with calculating that, right? Everybody is happy with 1.1.
Okay, sir.
Okay, then let's go to quick ratio or acid ratio. What is the figure for X? X means what I'm asking is what is numerator, right?
539.
Yes, I think it's 539. How we get it? We get 877 and deduct the inventory. Ne? We deduct inventory or we remove inventory. And as I said earlier, for example, prepaid expenses. prepaid expenses are not even disclosed on the face of the financial statements. Maybe if you go to notes, we may be able to find how much is prepaid expenses, but the notes are not attached, so we don't know it, right? And I think it's not material, because if it is material, it should have been disclosed on the face of the financial statements. Okay, there is another unrelated question which I also do not know. Maybe it is an industry-specific term. Maybe some people who are very good at accounting standards understand it. There are biological assets. I don't know, right? Maybe only the plantation people know about that. Maybe it is plantations. I don't know. Something relating to because plantations, they have biological assets. Maybe tea plants, maybe rubber plants. I don't know. Right. Anyway, interesting question, right? I don't know. Anyway, we don't need to know it under this topic. So 539 is okay. It's 877 minus inventory is 338. 877 minus 338 is equal to 539. That is our monetary current assets divided by same current liability 785. Then the answer will be 0.69. That also, if we take with that benchmark, is not sufficient, right? Because the textbook benchmark says quick ratio should be 1:1, but this firm has not maintained that. But according to my opinion, there is no problem with that, right? I mean, just because textbook says 1:1, we don't need to maintain 1:1. If that company is happy with this 0.69, that's okay. If the stakeholders are happy with that, no problem, right? Anyway, actually, this firm has been in trouble during 2020, right? It is not a good year for LPT London. If you look at 2021 annual reports, there are much better figures in 2021. I just purposely selected 2020 for a few reasons. So quick ratio, okay, right? Just we exclude inventory. And then let's go to inventory turnover. Arangen. See whether you can calculate inventory turnover using LPT plantation. For the moment, we will not take average values. We will take year-end figures, right? For simplicity. For example, in my formula, maybe it is mentioned average inventory, but let's for the moment take year-end values instead of average values, right? Because averages just complicate the calculation. So we need cost of sales and year-end inventory. Yeah, it is. How much is the cost of sales? It's not sales, right? Cost of sales. Yeah, it is 2,824. 24 or 23, whatever, right? If you round, it will be 24, but if you don't round, no problem. 2,823 or 24. Then inventory we took already, that is 338. That means our ratio will be 8.35 or 36. Yeah, so we are just calculating, we are not trying to interpret, because in order to interpret, we have to either compare it with some firm or compare it with the previous year, right? For example, if you want, we can compute the same for 2019 and see what has happened. But it will take time, therefore I will not do it in the class. But I ask kindly from all of you, please do the same calculation for 2019, self-calculation. And also I have given the similar financial statements for Namanukula plantations and calculate it for Namanukula as well. And then you will have certain questions, right? Try to interpret them. I mean, what has happened 2019 and 2020, what is going on in Namanukula and what is going on in LPTF. And if you have that type of concerns, please come up with those questions to the next week class, and we will discuss more about changes in those ratios, right? I mean, when we compare with Namanukula and also with the previous year. Otherwise, if you do all the calculations here, it will take a long time, right? So it is 8.36. That means our inventory is converted into sales around 8 times a year, right? 8 times a year. We don't know whether it is quicker or slower, because we don't know how other plantations are doing it, right? Then we will look at receivables turnover. Receivables turnover. Here there is a problem, right? Because we don't know credit sales. Because receivables turnover calculation requires credit sales, but credit sales are not given. Therefore, we will take sales, total sales. $3,287 divided by accounts receivables. Okay? We will not take average this time. How much is accounts receivable? It should be under current assets. Trade and other receivables, right? Trade and other receivables, 261. 260 or 261, that's okay. Then the ratio will be how much? Yeah, it's 12.6. 12.6 times. None of these ratios are expressed as percentages, right? Ratio percentage right? None of these are ratios. None of these are percentages. This is number of times, 12.6 times. Earlier inventory turnover 8.3 times. Then current ratio and asset ratio is like 1.1 to 1, 0.69 to 1, something like that. Not percentages, right? So receivables turnover indicate that our receivables are converted into cash roughly around 12 times a year. That means roughly our collection period is 1 month, right? Collection period is 1 month because 12 times a year. That means usual credit period given to our debtors is around 1 month, right? Roughly. But if you want to, there is another indicator, right? Receivables period. I have not discussed it here, but there is that also, receivables period. Receivables period. So that is usually calculated by 360 divided by receivables turnover. Receivables turnover, right? So that means 360 divided by 12.6. How much is that? You can take 360 or 365, whatever number of days per year, right? 360 divided by 12.6. 28, ne? That means roughly it is around 28 days. Receivables period is around 28 days. That means 1 month credit period, right? Usually in credit terms, 30 days. 30 days. Maybe they are giving 30 days credit period, right? Some firms give 2 weeks, some firms give 4 weeks, 14 days, 60 days, 90 days. Usually credit terms are like that. No? So maybe LPT is following 30-day credit period. Then, okay, then just remember that also, right? There is a ratio called receivables period also. That may be expressed in months or days, maybe weeks also, right? We can say 28 days means it's 4 weeks. That was not there in the slides. Then debt to equity ratio. I like if everybody contribute, right? Then only this class becomes interesting. I really thank those who provide answers. This is again, we should go to balance sheet, right? Both figures should be on the balance sheet. Any idea about the two numbers that we have to use?
Total liabilities into total equity.
Yes. Total liabilities. Actually, yeah, you are right. Actually, it has to be long-term debt, right? When we calculate debt to equity ratio, we don't. What I have given in my slides maybe sometimes wrong. Let me check. What I have given is total debt. Ne? Total debt should be actually total long-term debt, right? Maybe I could not explain it there. When we calculate total debt to asset ratio or debt to equity ratio, actually we have to take total long-term debt. However, if we consistently calculate total debt and use total debt for all firms and across years, that is also fine, right? For example, not only for this firm, for other firms also we take total debt. For previous years also we use total debt, I mean total liability. Then in that case, no problem because comparison can be done. Right? But in most, actually generally when we calculate solvency ratios, it is better to take only the long-term ones, right? So when we take equity, it is long-term anyway. When we take debt also, it is better to take only the long-term debt. Right, so there can be two answers here. If we take long-term debt, there will be one answer. If we take all debt, all liabilities, there will be another answer, right? That's okay. For example, if we take total liabilities, it will be 2,470 divided by 4,505, right? So that is what I have done also. I think if you can see these numbers, it is 2,470 divided by 4,505, where we have taken total liabilities, right? For example, when we calculate debt to equity ratio in banks, this is the approach. Because in banks, you know that we can't separate what are the current liabilities, what are the long-term liabilities. Like that, we do not usually categorize. Right? And in some other industries also, that categorization is not so easy. But for plantations, maybe they can, without any problem, categorize what is current liabilities, what is long-term liabilities. But for financial institutions, definitely we don't do that. Right? Therefore, we have some excuse for using total liability as well. But since plantation is a kind of real non-financial business, I think taking only long-term debt would be more appropriate, right? So if you take like this, it will be around 0.5. Right? So it's like half of the capital relative to equity is debt. Not a big issue, right? Because we have, if we have 100 equity, we have only 50 debt. So if there is a problem, easily we can pay off the debt. But if the debt to equity ratio is very high and if debt exceeds equity, then the risk is high, financial risk is high, right? If we take only the long-term liabilities, we have to take this total non-current liability, then it will be around 1,685, right? So we can calculate the same ratio using this and this also, right? In that case, leverage will be even lower, right? Okay. According to Chaitanya, it is 0.37. Right? So it's even a better position, right? So anyway, we have to understand how we have calculated the ratio, right? So my recommendation is you use whatever technique you like. For financial institutions, definitely we take total liabilities. But for non-financial firms, it's more appropriate to take only the long-term liabilities when we calculate debt to equity ratio, debt to asset ratio, whatever the solvency ratios, whatever the leverage ratios, right? Because some firms try to manipulate also. For example, in Sri Lanka also, sometimes we do that. No? We have a swap with Bangladesh, and some people say it is a swap. No, it is not. It's not the loan, right? It is swap. Like that, if we take loans and if it is negatively interpreted, we may take loans, but that does not look like no loans, right? Like that, I mean, we may try to categorize some of the long-term liabilities as current liabilities using some methods, right? It's not very easy because there are accounting standards preventing such action. But anyway, if you do the comparison consistently, no issue, right? For example, if you take total liabilities for all the firms and calculate the debt equity ratio, there's no problem. Then equity multiplier. Please give me the two numbers also, right? What is the numerator? What is the denominator? Total assets divided by equity, right? Yeah, total assets is 6,975. Total equity is 4,505. The ratio is 1.5. That also tells that we are levered to some extent, right? Not heavily, but we are levered to some extent because we have more assets than equity. That means part of assets have been financed with debt, right? So it just tells me that we have some degree of leverage. We can't say whether it is good or bad, right? It's not much also. Then profit margin. Actually, it is net profit margin, right? Net profit divided by sales. Can you find it? Yeah, in this financial statement, it is recognized as profit for the year, right? Profit for the year, that was 242 or 241 if you like, right? Profit for the year, and then sales 3,287. 3,287. That is 0.07. Yeah, it's like 7%. Okay, that's the percentage, right? That's the percentage. Debt to equity ratio also, if we like, we can express it as a percentage, right? For example, instead of saying 0.5, we can say 50%, right? But equity multiplier is not expressed as a percentage, right? It's always number of times. Profit margin is usually a percentage, right? So it's in this case it's 7% or 8%, very close to 7 point something. And then return on assets is another percentage, right? So can you calculate return on assets? Return will be same, right? 242. This time instead of sales, we divide it by total assets. $6,974, right? 6,975 total assets. Then it's 3%, 3 point something. And then we will go to return on equity. That is also usually expressed as a percentage. What is return on equity? I think if you can do these calculations, you don't have to worry about the examination, right? Calculation part of the examination. So what I'm trying to imply is at least you must be able to calculate these ratios with your memory, right? Memory means you don't try to remember the formulas, but try to remember the logic behind the formula, then you can develop the formula yourself. That is what I'm trying to say. If you can't figure out the logic behind any formula, just let me know. Then I will let you know how to remember it easily. So return will be same, right? It's same return 242 because in this case there are no preference dividend, right? We can't see any preference shares here. The problem comes only when there are preference shares. If there are preference shares, we have to deduct preference dividend from the return. But in this LPT plantation, there are no indication of preference shares. Maybe, I don't know, in Note 25 whether they have preference shares. We don't have Note 25 at the moment. Therefore, let's take it as total ordinary shares. As I remember, it is totally ordinary shares, right? If you want, you can go to LPT Plantation website and download the entire annual report and fine-tune your ratios, but assume that we don't know the information contained in the notes. Therefore, seemingly there are no preference shares. Therefore, return under concern is 242. Same return, profit after tax. Then equity is 4,505, right? 4,505. That gives us around 5.3, 5.37%. Actually, if you look at the annual report, this figure is given in the annual report also, 5.37 under summary indicators. And then let's go to fixed asset turnover. How about that? Fixed asset turnover.
Revenue divided by the non-current assets.
Yes, non-current assets. Why I'm getting different answers here? Non-current assets should be 6,097, right? Sales, how much is sales? Okay, 3,287 divided by 6,097. That's 0.54, 0.5. That is also not a percentage usually, right? So it's number of times usually. As I said earlier, actually this firm was under trouble, I think, in 2020. So fixed asset turnover of this much is not so good. Not so good, right? I mean, usually, anyway, I don't know about plantations much because you know that in plantation there are a lot of fixed assets, no? A lot of land, particularly. A lot of land, maybe if they have factories, etc. So maybe this is normal for a plantation, but for a bank, for example, this is not so good, right? In banks, fixed assets constitute a very small fraction of total assets. For financial institutions, this is totally upset. But I don't know exactly what's the situation in plantations. Maybe if you look at Namanukala situation also, we can get some idea, right? But let's see if you do it, we can discuss next week. Then let's go to total asset turnover. This is fixed asset turnover. This is total asset turnover, right? Yeah. Sales will be 3,287. Then we have to take total assets. Total assets 6,974. You can see 6,974. Fixed assets 6,097. Total assets 6,974. That means their current assets are negligible, right? I mean, we can just ignore current asset part because maybe because of the huge states they have, right? Current assets is like 10 times smaller than fixed assets. So that's 0.47, eh? 0.47. It should be 0.47, right? It cannot be 47% or something. It should be 0.47. Okay, then since some of the information is not contained in the financial statements, I have given the market value of equity here. Then we have to find the book value of equity. That's one way of calculating Tobin-Skew, right? One is taking the market value of the firm and book value of the firm. Since in this case, I find it's a bit difficult to find the market value of the firm because I don't know whether they have debt also. Calculating market value of debt is a little complicated. Therefore, I am trying to go for a simpler Tobin-Skew formula, that is market value of equity divided by book value of equity, right? That's a simpler formula. Or we can take market value of equity and net worth here. The market value of equity in that particular year is 947. Just tell me what is the book value of equity. Yes, 4,504, 4,505, right? Whatever. Then Tobin-Skew, how much is that? Yeah, it's very bad situation, but I will explain this, right? 0.21, 0.21, right? So, as I explained earlier, is it undervaluation or an overvaluation? I mean, we have to interpret in this way, right? Is this firm profitable this year? Did they have profits, or were they making losses? This year and last year, is it profit or loss?
Profit.
It's profit, right? It's profit. Firm is making profits. However, the market value is substantially below the book value, right? Therefore, what is your opinion? Is the firm in trouble? I mean, firm is permanently in trouble, or is it short-term something? I think this is a short-term something, right? Because firm is, I mean, not only in 2020, but also in 2019, the firm is making profits. But due to some unfavorable expectation about this particular firm or about the industry as a whole, the share prices of that industry or this firm exactly is much lower. That is why the market value of equity is very low. Actually, I did not very carefully check it, but when I checked the Colombo Stock Exchange website, I found that in 2020, I took actually December, right? But actually, these financial statement figures are for 2020 March. I could not exactly find this particular day's share price, but it was around 13 rupees per share. Yeah, that is what I'm explaining, right? So I just multiplied 13 by number of shares listed in the Colombo Stock Exchange. It was around 72,000 something, right? It is not in the annual report. I could not find it from the annual report. I got it from the Colombo Stock Exchange website, right? Maybe there is a place which mentions number of shares and share price of that firm in the annual report, but I could not, actually I did not find that seriously, right? I just got the share price and number of shares from the Colombo Stock Exchange website. So when I multiply 13 by 72,000 something, it came to 947 million. 947 million. So I'm not very sure about that figure's correctness, but just take it, right? But later I found that the value was around 40 something, 40 rupees when they published 2021 annual reports. And the latest, if you look at the share price now, it is around 65. That's what I'm trying to say also, right? For example, you can see here 13, in the next year it is 40, and now I think at the moment it's around 65 or 67. Now I can't remember. I just checked it in the morning. It's around 65, right? Because maybe because this is because of COVID-19, right? Because during the COVID-19 they a lot of problems. Therefore, share price went down. Now it is kind of recovering. The export sector is recovering, therefore the prices are going up. So if you calculate Robin's Q for 2021, it will be a completely different picture. And somebody raised hand. Do you have anything to say? I'm sorry, I could not give the opportunity at that time. Is there any question?
So 947, how do you get?
13 rupees per share, and number of shares, I can't remember. This is the number of shares. 72,866,430 shares multiplied by 13 per share. It's not in the annual report, I'm sorry, right? Just share price multiplied by number of shares. Then that gives the market value of equity. Okay. As I said, I am not sure about the 13 because 72,866 is for 2020 March 31st. 13 rupees, I think, is not March 31st, right? Just a rough calculation. Anyway, what I wanted to say that this 0.21 actually is not indicating a problem in the firm, because firm is making profits. There is nothing wrong with the fundamentals of the firm, but market has undervalued this firm. Right? The main reason for that undervaluation is negative information about the progress of export sector. Right? Maybe because this pandemic, this 2019-2020 period, so maybe workers are not working, the factory may be closed down, maybe exports has been stopped, maybe markets have been closed down. I mean, no transportation, no shipping, maybe demand for tea or rubber has been declined in foreign countries. Therefore, investors might have perceived that the plantation sector is in big trouble. Therefore, actually we have to analyze it, right? I'm just talking surface discussion here. If you look at what has happened to the share prices of the plantation sector companies, I probably suspect that in almost all the companies, the share prices might have gone down during this 2019 and 2020 period. But recently you observed that some countries have now opened, now shipping is working, transport is working. So maybe this agricultural sector is recovering, right? With that recovery, maybe the share prices are increasing rapidly again. You can see it's very rapid. I mean, this is 2020. This is 2021 March, and this is 2021. Now it's September, right? I mean, within few months, see how much increase in the share price can be seen. That is why, I mean, if we had the positive impression that COVID will be okay soon and this is undervalued firm, and what happens if we purchased around some number of shares of this company? We have made a huge profit, right? For example, if I purchase just 1,000 shares, I just need to spend only 13,000 at that time. But now I can get 65,000 within 2 years, 1.5 years, right? I would have made a huge. That's the importance of this Tobin skew, right? If there is no problem in the company, if the Tobin skew is lower still, it's probably a market anomaly. Probably market has mispriced or undervalued that firm. Probably that price will go up, right? As evidenced in this case. Actually, it's interesting if you investigate all the plantation companies. For example, still maybe hotel companies are experiencing the same issue because hotel sector has not still recovered, right? Maybe Tobin skew in the hotel sector these days should be much lower. But for example, when the vaccination is over, when the country is open, when the tourists are coming, Tobin skews pick up. Right? Any other questions? If you have a question, anytime you type it, right? Type it or raise hand. I will try to answer it. Then earning per share. Can you calculate the earning per share? Again, number of shares is not given in the annual report that I shared. Therefore, I have given here the number of shares. It is not in millions. Therefore, take the earnings also in normal figures, right? Do not convert it into millions. This is the number of shares. Yeah, it's actually it's given in the annual report also, right? It's 3.3. Actually, it has been calculated using 241,710,181 divided by this. Is that correct? I did not check it. 241,710,181 divided by 72, 8 is 866, 430. Yeah, 3.31. That means number of shares correct, right? As I got from the CSC. Because in the annual report, you can see just below the profit and loss account, they have reported earnings per share as well, right? So that earnings per share and our calculated earnings per share match. Therefore, I can confirm that number of shares are correct. Therefore, this calculation should also be correct approximately, right? So when you multiply 72,866,430 by 13, you should get 947. Can you check that also? 72,866,430 multiplied by 13, 947,263,590. Right? That's how I calculated 947. Just multiply this number by 13. 13 is the share price at that time, right? Okay. Do you have any problem with calculating this? Yeah, interesting question. Why this is called Tobin's Q, right? Actually, it is Q ratio, right? Actually, it is Q ratio, but it has been introduced by Tobin. Therefore, since it is Q ratio, that is Tobin's Q. Right? This Tobin is a person. It's a person's name. It's interesting, right? So if you introduce another ratio, okay, this is not good and this is the best ratio, you can give it your name. For example, Jayalats, he said, whatever. Okay. Because that's how people commonly call it in research, right? In practice, as I said earlier, it's not frequently used. But you see that it makes sense, right? I mean, it's very useful ratio. I mean, you have to actually you don't look at Tobin's Q alone. If you look at Tobin's Q, at the same time, look at what's happening in the economy and what's happening in the company, then I think you can make a very good investment in the share market. If the Tobin's Q is very low, as I mentioned earlier, in this case, if the company doesn't have any problem, if this low Tobin's Q is mainly a result of pessimism in the market, you know that pessimism doesn't last longer. Someday it reversed, right? Therefore, if you find companies with very low Tobin's Q, and if the company doesn't have solvency issue, definitely their share prices will go up in the future. One such sector, as I suspect these days, is hotel sector, because it did not recover yet, right? Because tourists are not coming yet, but there are signs of recovering. I don't know whether already speculation started. I think it has started for plantation sector earlier. Hotel and tourism, I think, will be followed. Even textile, textile firms also picked up even before plantation sector. So then these market ratios, as I explained in my previous slide, is one good ratio to make such decisions. Okay. Then I know you are tired, but since we have time, we will go for another exercise. Well, this is a bit complicated, right? And the ratios have been given. Inventory turnover, uh, debt to equity ratio, days receivable, profit margin, total asset turnover, quick ratio, current ratio, equity multiplier, etc. are given, right? For one firm for 3 years. This is the oldest one, 97, 98, 99, right? So make sure that you read it correctly, right? This is the oldest period. This is the latest period, kind of coming backward, and this is the industry average. In that sector, these are the averages, right? So by looking at these ratios, Tell me something that you can tell about this firm. It's a product manufacturing firm. What can you observe? Actually, this is the most important part, right? I mean, calculation part, I think, more suitable for A levels, not for expert bankers like you, right? Therefore, don't expect much calculation, but expect more marks for interpretations. Okay, when you say, just tell me how you got that point, right? For example, Deshan say sales has been increased, but where you found it? Yeah, I think Deshan is talking about the inventory turnover, right? Because inventory turnover has increased substantially. That means number of times we sell our inventory has increased. So possibly an increase in sales, right? Okay, what else? Just give me your ideas and we will discuss later, right? Later means at the end of your ideas, we will discuss all the ideas. Yes, equity multiplier is getting lower. That means firm is delivering, eh? Leverage is going down. Not very simple interpretations, right? I mean, why it has happened? What are the possible reasons? That is what I want. For example, inventory turnover has gone up, yes. Why? What is possibly happening? Other than that, I can also say, okay, inventory turnover is higher than 1997. Current ratio is higher than 1997. That's not the interpretation, right? Why? What is going on in this firm? Okay, that's one good interpretation. I don't say whether it is correct or wrong, but as an interpretation, that is good. Price of goods has been increased, as Dakshina says, right? Because it's not given here. He has somehow figured out that, right? I don't know whether it's correct or wrong, but for the moment, I think that's a good interpretation. Okay, as Laknath say, firm's market has been expanded, right? So that's an interpretation, yes. Okay, Minruat is saying that firm has taken more debt in 1999. Yes, good interpretation. Okay, as Sudeshan say, profit margin has been decreased as an effort to increase sales, right? Okay, that's a good interpretation. It may be wrong, it may be right. That doesn't matter, right? I just want to know your imagination, how you imagine things in this company by just looking at the numbers presented. And whether it is correct or wrong, it's a separate issue. Because the different people can interpret this in different ways, because what we have only this information, right? We don't have any other information. Therefore, a lot of assumptions can be there. Any other observations? Okay, for example, let's look at one interpretation, right? Just to see how we are going to make it a plausible interpretation, right? Okay, I will come to Mohan later. Let's take the Udeshan's answer first, right? He says profit margin decreased to increase sales. Do you agree with that? Okay, let's go with Udeshan, right? He says the firm has reduced the profit margin to increase sales. What do you think about that?
Profit margin has been increased year by year.
Yeah, that's right. Yes. Contrary to what Udeshan said, actually profit margin has not been decreased, right? Because profit margin, you can see the ratio is already given here. Therefore, 6%, 7%, 8%. That means profit margin has been increased. That means they have used another method to boost the sales. What could that be? Because inventory turnover has increased, that means somehow they are turning inventory into sales more quickly than earlier. But profit margin also has been increased, as you said. Yeah, one is good marketing, but is it reflected in the numbers? Did you see this? Days sales receivable collection period. Yeah, sales definitely increased. But at the same time, you can see what has happened to collection period, receivables collection period.
Increased.
Increased, ne? For example, when we calculated for LPTA plantation, it was around 30 days. But maybe they are following 90-day period or whatever, but you can see it is 94, 98, 113, like that. As Lakshnath said, maybe they have moved from more strict credit policy into a more flexible credit terms or extended credit period, or as Lakshnath say, maybe more credit sales, right? Not only to credit-worthy borrowers, but also to little bit weak buyers they are selling, I think. Therefore, it seems that the firm is experiencing some problems in collection, right? Sales receipts. So maybe that is the approach that they have probably implemented to increase sales, right? More liberal credit terms, extended credit period, or selling to everybody on credit basis, right? Not only to familiar credit worthy customers, but selling to everyone. So that's why receivables period has been increased. Anything else? Yeah, sounds are correct. That is what we are telling, right? Inventory turnover is increasing. That means they are selling faster. Selling faster is mainly attributable to that liberal credit term, more flexible credit terms. Okay, that's about sales. And how about others? Any other idea? So what did you say earlier? Okay, there is a mismatch of debtor turnover and creditor turnover according to Mohan. Days receivables, where did you compare? With what did you compare it?
Yeah, that is the inventory turnover actually increased from 1997 to 1998 from 32 to 62. Meanwhile, the days sales in receivables also has been increased 94 to 113 in
Yes.
1999. So it may be a cause to liquidity problems.
Yeah, that's correct. That's correct. I mean, definitely, the firm's short-term, short-term liquidity goes down. They need some other means of financing their current liabilities because they take longer to recover from debtors. That's correct. Good. Any other observations? Dakshina say price of goods has been increased. It's possible, but if the price of goods were increased, maybe sales decrease, right? So we don't have a strong foundation to say that price increased. But with this profit margin increase, maybe as you said, there might be an increase in the price as well. Yeah, we have to argue it like that, right?
Excuse me, there's a big gap time interest earned from 1997 to 1919.
Yes.
It was 4.45 in 1997, but it was 0.9 in 1999.
Yeah. So what is the reason? What is the possible reason? It's a good point, yes. I mean, profit margin has been increased in 1999. Inventory turnover is better. So why is it like this? I mean, in all aspects, we are better than 1998, ne? So why it is going in the unfavorable side? Miniruan says a lot of debt has been taken in 1999. How did you say that? Well, the equity multiplier has been decreased, right? How do you say interest expenses are high? Yeah, my question is how do you say interest is high? But this interest times interest earned does not indicate anything about expansion of debt. For example, you can see debt to equity reduced. That does not allow us to say that debt has been increased. Equity multiplier has been reduced. That means it's an indication of delevering, right? Reducing leverage. So debt has not been increased for sure, because debt to equity ratio has been gradually reducing. Equity multiplier is reducing. Therefore, for sure, debt has been decreased. What other drastic change can you observe in 1999? Very good, very good. Chamara. It's depreciation, right? Because of this, you can see earlier it's 1%, 1%, 25%. I don't know what's happening there, ne? There's a huge increase in depreciation. Maybe some asset broke down and they had to write it off. In
Technology
1990.
change.
Sorry?
Technology change.
Technology change, yes. Machine become obsolete. Yeah, something like that. Maybe change in the accounting standards, and accounting standards allow us more depreciation according to new standards, so they may write off certain things. I don't know, right? So definitely, as you said, this times interest earned has reduced because of this increased depreciation. Because when the depreciation increase, net income, profit declines, right? I mean, accrual basis profit declines. It's not actually a cash flow, I agree, but profit declines. So when the profit goes down, even though the interest payment remains same, times interest earned reduce. Right? So this is not an indication of increased debt for sure, because equity multiplier and debt to equity ratio shows a reduction. Therefore, this interest coverage reduction is mainly attributable to increase in the depreciation. Right? Okay, then actually we can give a lot of interpretations like this on these figures based on our imagination, assumption, and also we can compare with industry average and say still the firm is okay or firm is uh, not okay or whatever, right? So my expectation is at least you should be able to write three things happening in this firm by looking at this information. I think now we can tell, right? For example, by looking at inventory turnover, days, sales in receivables, and also profit margin, we can tell something about the sales strategy of the firm. And also by looking at equity multiplier, debt to equity ratio, etc., we can tell about the leverage of the firm, right? Whether it's increasing, whether it's decreasing. And also by looking at this depreciation, interest earned, also we can say something about why interest coverage has been reduced, whether it is a short-term phenomenon or long-term phenomenon. For example, if you look at why depreciation is so high in that year, we may find an explanation to that question, right? So if it is one-off depreciation, we don't have to worry. But if we are going to have the same depreciation in the next couple of years also, that will be a problem. How about quick ratio and current ratio? Together with inventory turnover, what can you tell about that? Particularly quick ratio and current ratio.
Working capital management is good.
Yeah, generally, maybe it is good, but what has happened over time, 97, 98, 99, for example, current ratio has improved, but quick ratio has not improved, right? Yeah, as Murthy say, quick ratio has not been increased. It is same. Current ratio has increased. Therefore, are you going to interpret it as a good working capital management? Yeah, I think Murthy is correct. Current ratio increase when the quick ratio remains constant. That means the only difference between these two ratios is inventory. That means inventory is piling up, right? Even though we have implemented a very liberal credit policy to increase sales, still we are not good at managing inventory. Inventory is getting increased. So maybe on some aspects our working capital management is good, but in terms of inventory management, maybe we are not good. Right? Maybe we can reduce the amount of inventory further, like in 1997, right? I don't know. Probably as definitely inventory is increasing, but that increase in inventory is a good thing or bad thing, actually we can't say. But when we compare it with the industry, it's not a big problem also, right? In industry, current ratio is 1.25. We are just 1.33. So that's not a huge difference. Therefore, we are not in a bad position, but we can see that in terms of inventory management, we are kind of not performing well. Something like that, if you can tell three things, whatever three things, right? Based on these numbers, based on your imagination and assumptions, I think you can get the full marks. Only thing is, you can't just say that this is good, this is bad, something like that. You have to exactly say, as indicated by this ratio and that ratio, this is happening in that firm, right? Like that, with the justification, you have to say it. Are you okay with that?
So excuse me, in our analysis, we don't use the industry average for any time. Can we analyze with that also what we can do, what we can say?
Of course, yes. But that's simple. That is why I did not cover it here, right? Because comparing our one with industry is very simple. But analyzing the trend is more important in my opinion, right? For example, saying now current ratio is 1.33, industry 1.25. So we are better than industry. I mean, that doesn't make much sense, right? But if we can combine it with, like, for example, what? Okay, days sales in receivables, right? Days sales in receivables, as we mentioned earlier, we are going into a bad position, right? For example, 94, 98, 113. As we said, we have implemented the liberal credit policy, so we have some trouble in collecting from debtors. But when we compare it with industry, we don't have to worry. And still we don't have to worry because 113 is not much. The industry average is 130. Yes. So that analysis is much has much value. But if you just say our days sales in receivable is 113, industry is 130, so we don't have to worry, that is also correct. But it doesn't have much depth, right? No much weight in that. But if you say our sales receivable collection is becoming worse, but still we don't have to worry because industry is having a much higher ratio. That's good, right? But if you just compare with industry average, I think that's not sufficient. Okay, Mohan?
Yes,
Is
sir.
that Mohan? Yeah. So always try to make it a broader discussion, right? As much as possible. So that may not be visible when we just look at the numbers, but you have to look at different ratios and think in a kind of a broad manner. Then it's not difficult, right? Okay, if you have, okay. Okay, that's another good question from Dilam Dhananti Jasing, right? Sorry. So inventory turnover can improve due to two reasons, right? For example, if you reduce the inventory turnover increase. At the same time, if you increase the sales, inventory turnover increase, right? So two things can happen when the inventory turnover increase. Either sales can increase, either inventory can go down. Sales remain same, inventory goes down, inventory turnover goes up. Inventory remains same, sales goes up, inventory turnover goes up, right? So two cases, because there is a denominator and numerator. So whenever you change one, the ratio change. Therefore, our argument so far was this inventory turnover has been increased not because of reduced inventory, but because of increased sales, right? Actually, inventory has been increasing, sales has been increasing at a much faster rate. Therefore, inventory turnover is increasing, right? Compared to past, we have more inventory, that's true. But our sales is much larger. Therefore, inventory turnover is higher. But still, we have more inventory. You got my point? Example is cost of sales divided by inventory, right? For example, if we keep inventory 100 and cost of sales increase from 100 to 200, then our inventory turnover increase from 1 to 2, right? There is no change in inventory, but only the cost of sales increased. Average inventory is same, right? But same thing can happen if we keep the cost of sales same, but reduce inventory to 50. In that case also, inventory turnover becomes 2. But in this case, we have reduced the average amount of inventory. But in this case, we have increased the amount of sales. Right? But in this particular example, based on profit margin, days sales in receivables, we don't have any basis to say that sales has gone down. Sales has increased, inventory has also increased according to this, but percentage increase in sales is higher than percentage increase in inventory. That is why inventory turnover has increased. Is that okay, Jayasinha? Okay, anyway, you don't have to have the same opinion like me, right? That is not what is expected in this case. You need to have your own argument, a plausible argument, justifiable argument, right? If you say, okay, this has happened as indicated by this ratio and that ratio. If that argument is sound, the answer is correct. It doesn't have to be my answer, right? You can have your own argument as reflected in this and that. It is this. Okay. Okay, for example, if you say we can't say that firm has not managed inventory properly, can you say that firm has managed inventory properly? Based on what? Right? So if you can explain that, that is also a correct answer, right? For example, if you want to say that firm is managing inventory well now compared to past, provide it with an justification. Okay. So there are no correct answers here, right? Because we are actually looking at only very limited information. No? Okay. So your creativity and imagination is the main player behind this answer. Because we have only these numbers. But if you really want to give a proper interpretation, we need a lot of other information, right? Okay, that's also good imagination, right? Maybe a new competitor came to the market. Good point, but with what ratio you are telling that? If a new competitor came, our sales should go down, right? But it seems that we are selling well. Because inventory turnover increased, no? Yeah, inventory stays, but inventory turnover has increased. That means we are selling faster, but we are running with the larger inventory. That's the problem. For example, you know that Toyota, what is the inventory management system of Toyota? How do they maintain inventory? Do they maintain inventory? They don't maintain inventory, right? Their production technology is known as just-in-time production, JIT production, right? That means when JIT, yes, good. I mean, when there is an order for a particular car, they get parts and assemble, sell. So there are no raw material parts in the inventory. There are no produced cars in the inventory. No finished goods inventory. No raw materials inventory. Just in time, right? Does that mean that they are not selling cars? They are selling, right? But they are not maintaining inventory. So we can, I mean, irrespective of inventory turnover, we can reduce then, for example, if we have very strong connections with the suppliers, we can maintain very little amount of inventory. That is what I mean by proper inventory management, right? For example, assume that you are my supplier. And I am sure that anytime when I say, okay, I want this much of goods, you will send it within 3 days. Therefore, I want to keep only for 3-5 days requirement in my inventory. But if you are not reliable supplier, we have to keep a lot of inventory, because even if I ask you to send goods, you may not send on time. And therefore, I have to maintain a lot of inventory. But if we have good supplier relationships, since we can get inventory quickly, I don't need to hold a lot of inventory. So that's the better inventory management and poor inventory management, right? So maybe yes, you can say that inventory has been improved, but we don't have evidence here, right? We don't have evidence. I can't see evidence, right? So if you can justify, I am happy to listen to you. And also, also as Somersekar say, maybe new competitors came to the market, but it is not adequately evidenced with the numbers presented here. Right? Inventory stays, maybe not because of a competitor, but because poor inventory management. Because we can't say new competitors came because our inventory turnover increased. When inventory increase, inventory turnover can increase only when our sales increase. So sales cannot increase when there are more competitors. Okay. So ratio analysis are like that. I mean, by just looking at one ratio, we can't get an idea. We have to parallelly look at what happens to other ratios, right? Then only we can figure out what's happening really. So just don't look at a single ratio. Take time, right? Don't try to write the answer quickly. Take time, look at the numbers, think carefully, and then you will be able to find many interpretations. Actually, I said 3 interpretations, right? But I agree that this is slightly a complicated one. That's the reason that I took also when we practice a complicated one, it will be nothing for you to do a simple one. Okay. Any other ideas? Can we move on? Do you still have any doubts? Okay, these are some of the interpretations that I made, right? So these are mostly compatible with what you said. Current ratio has steadily increased, however, quick ratio remains same. Possibly an increase in the inventory. Inventory turnover increased, but trouble in collecting receivables. Asset turnover has gone down. I didn't even notice it now. Asset turnover. Yeah, but it's not a big decrease, right? 7, 6, 5, 5, 4, but not a big decrease, but decline in trend. That is dangerous, right? Even though small decrease continuously happen for a long period, it will be a big decrease. Asset turnover has been increased. That means sales are increasing, but asset turnover is decreasing. That means we are not efficient in using our assets. Maybe there are unutilized assets, unnecessary acquisition of assets. Maybe, I don't know. But as somebody said, you can see how we can integrate industry information here. Right? We have to give the interpretation first, then we can compare with the industry. But don't worry, others are also saying, right? Lanka rupee is depreciating, but don't worry, everybody is depreciating, so no problem, right? I don't know whether it's a justification, but we can say something like that. It's going down, but don't worry, industry is also going down. Okay. Equity multiplier may, okay, debt is becoming lower. That's clearly evidence, right? Let's leave that. This interest issue is also highlighted, right? So those are some of the, I have 5 here, maybe there are more. Which tutorial? Usually he uploads the records, right? He is recording, I think. He's uploading. So should I tell it or he will do it? Mr. Carling is not here, right?
Sir,
I will
upload Kaladan. Sir, you have been uploaded, sir.
मैं recording එකත් upload කරනවද?
Oh, sir.
All right, okay. Some people are asking you to upload it. So
Yes,
can you
sir,
please? Okay.
Yes.
Thank you very much, Mr. Carling. Okay, interpretations are blank. Now you can take a screenshot, right? Because I purposefully kept it blank. Otherwise, what you do is you just read my interpretations, right? Maybe these are wrong also. Now you can take a screenshot and save it, but try to have your own interpretations, right? Mr. Carlinger doesn't have this version, and I will not give him also. Okay, then since time is over, shall we stop? And if you have any questions, I am ready to answer a few more questions. And if you don't have questions, I think you are free to leave if Mr. Carlinger doesn't have any announcements. Mr. Carlinger, want to have announcements in class?
No, sir.
Right, then so we can stop, right? Thank you very much. See you.
Excuse me, sir.
Yeah,
Do
sure.
we need to calculate the ratios, Namanukula? or is it?
I do the forms, but it's always better try to calculate because financial statements are different. Sometimes you may find it is difficult to figure out which number we want to take. So if you try to calculate and if you experience any problems, come to next class with those issues and we will resolve those issues in the class. It's not mandatory.
Okay, sir.
Okay, then thank you very much.